Welcome to today's market report. European stock hit a near one-month low on Thursday, following Wall Street's worst sell-off since October on concerns about high valuations, with investors also growing wary about a rise in more contagious coronavirus variants. The pan-European stock 600 fell 1%, turning negative for the year, while major regional bourses like DAX and CAC slid further into the red, and FTSE 100 held on to slim gains for the year. Investors looked past strong earnings from Apple and Facebook overnight, as well as the US Federal Reserve's pledge to stick to loose monetary policy, as worries about slow rollout of COVID-19 vaccines and more curbs in Europe weighed on the mood. Germany is preparing entry restrictions for travellers from Britain, Brazil and South Africa, while its health minister expects the current shortage of coronavirus vaccines to continue well into April. Miners, technology, oil and gas were the biggest decliners among sectors, falling between 1.5% to 1.6%. Diego jumped 4% after the world's largest spirits maker reported a surprise rise in underlying net sales growth in the first half of the year, helped by strong US demand. Oil declined following a slide in broader financial markets, even after the biggest draw in US crude stockpiles in 6 months. Crude futures traded 0.87% down at 52.39. Brent was down 0.76%, trading at 55.14. Gold was down 0.44%, trading at $1,836.55 per ounce. On the FX front, GBP/USD is consolidating the downside below 137 following the FOMC decision-led decline to near the 136.50 region. The Fed maintained the status quo and noted that the economic recovery hinges on the COVID situation and vaccine progress. Meanwhile, Fed Chair Powell refrained from commenting on tapering, while markets solid off risk and bid up the safe haven US dollar. The dollar remains on the front foot on Thursday, heading into the US Q4 GDP release, pressuring the downside in the cable. Meanwhile, the pound suffers from the EU-UK tussle on the COVID vaccines from AstraZeneca. The technical outlook for the spot remains bearish in the near term, with a retest of the 136.50 level, likely on a breach of the critical 200-hour moving average at 136.65. The bears remain in control as the 21 HMA has cut the 100 HMA from above, representing a bearish crossover on the hourly sticks. The relative strength index also looks south below the middle line, allowing room for more declines. A failure to defend the daily lows at 136.51 could expose the 21 daily moving average at 136.40, which is the latest straw for the GBP bulls. The price hasn't closed below that level since 11th of January. Alternatively, any pullbacks could be short-lived near 136.90, the conference of the 21 and 100 HMAs. The next upside target for the buyers is seen at the 50 HMA at 137.02. The bull trend in Eurodollar is seen unchanged in the medium term, in spite of the recent price action. The pair came under downside pressure yesterday. It has eroded the 55-day moving average, and attention has dropped to 120.14, the September high, and the 120.03, the 2020 to 2021 uptrend, which we suspect will hold. Assuming that the uptrend 120.03 and 23.6% retracement of the move up since March 2020 of the level of 119.45 holds, medium term the bull trend remains intact and targets the 125.56 2018 high and 126.24 the 200-month moving average, which remains our longer term target. The US dollar edged higher in early European trading on Thursday, continuing the previous session's gains, with traders becoming more risk-averse after hefty stock market losses. The dollar index was up 0.1% at 90.75, adding to the Wednesday's 0.6% gain. Dollar yen rose 0.2% at 104.31. Aussie dollar was down 0.6% at 0.7613. The main equity indices on Wall Street saw their biggest one-day percentage drops in 3 months during the previous session, as hedge funds liquidated positions to raise liquidity after suffering losses on short positions in other stocks amid highly speculative retail buying. This helped boost safe haven demand for the US currency. Traders await for the GDP data later for more impetus. This is today's market news. Thanks for listening. We'll see you next time.